Numbers Man here with This Week in Economics on the 18th of August 2013 as we roll on into more of a traditional summer pattern, and we'll get to that in just a second as to what is going on. Many of the movers, shakers, and wannabes on Wall Street and the financial world are on holiday. Those that have the wherewithal are in the Hamptons. Those that don't are touring the U.S. or other destinations abroad are in between the two. But they are out of the fray. In Washington, the Congress is on holiday also. The President is at Martha's Vineyard. Not much is going on here. In the U.S., continental Europe, we'll get to in a minute, the EU, etc., and the various appendages to Greece. In the Mideast, of course, they're preoccupied with the aftermath of what was called the Arab Summer. A reminder that most of the people in that section are under the age of 25. But tourism, Egypt's major industry, is facing all types of cancellations because tourists, like businesses, do not want to deal with chaos. So since there is utterly chaos, murder, mayhem, etc. going on in the streets, alleyways there, the tourists will not be there for the winter designations, various holiday period vacations. So we won't see that, but what we are seeing is some of the figures firm up here in the U.S., and we'll go to this. One note, and we've talked about this in previous episodes. The matrix we use to measure various things, in other words, our modeling, is many times flawed. If it's not flawed, the analysis of the data itself is flawed in terms of an over exuberant projections. In other words, when an analyst makes a projection for a certain industry within a sector or a sector in itself, for example, and we'll talk about in a minute, the personal computer or information technology sector, and more specifically, say, Dell Computer and the consequences of some structural shifts, being that the personal computer is no longer as personal. The mobile device has basically taken the place of much of that market, and many of those companies, including Dell, IBM, etc., are now forced to take shifts in their business models, make redundancies or layoffs across the board. And what plays also on top of this is something called cloud computing, or software as a service, hardware as a service, etc. In fly the Amazons of the world in that mix, and various others from IBM to other types of corporations that offer you the clouds, quite literally. So this has changed the structure of many, many things, and thus we have to look in terms of our models and what they tend to measure. The measurements have to be redone to reflect not only the new economic structures, as we just pointed out, but also at the same time the globalization of the economy and the ups and downs of various sectors. And we'll talk about China in a minute here as one very good example of what's going on, opening up to what is called international trade or international money. Let's get to the cut here. Not wanting to sound unscientific, but economics in itself is a study. It's not a scientific study, but it is based upon some analytics, we hope. So we'll get to this. Data on Friday suggested, this is from Reuters, recent spike in interest rates in anticipation of the Fed. They'll have a September meeting, tapering its massive bond purchases as early as next month. Well, perhaps they'll be tapered, but they will not be as they say, concluded. It's at 85 billion per month now. That's called quantitative easing, QE3, from the Thomson Reuters, University of Michigan, used to be the University of Michigan. This is a preliminary reading, on the overall index of consumer sentiment. It slipped to 80 from July's 6-month high of 85.1. Perhaps if we look at it, July was an outlier. The August reading was the lowest in 4 months, but again, we're in Q3. Later part of Q3 is going to Q4, and what sort of differentiates the last of this is the so-called back-to-school buying season. How does that affect consumers? And one has to also look at literally what the head count is in going back to school. I looked at an article recently about several of the larger retailers, the Walmarts of the world, etc., the Targets, all those that were in the school uniform business. Many schools, the private ones, have always required some type of quote-unquote uniform. Shirts, ties, whatever. And now some public schools have jumped into that boat, as it has an effect. There it's sort of like in the military, you have a uniform for this or a uniform for other things. But nonetheless, these retailers are in the business of selling the uniforms. So they see that as going up. But at the same time, many other things are not necessarily going up because of discounting, and also for the uniforms too. You can go to Amazon and buy your uniform, of course, of choice from many different retailers, brokers, etc. So this is not as rosy as they would project it to be. The walk-through traffic that people go into the various retailers has been on the decline. Of course, increased competition. Example there in the retail sector. The electronics former powerhouse, I guess it's still a house, called Best Buy. What they have done is turn their showroom into many showrooms. They have Microsoft there in part of the store, Samsung the other part of the store, and then I guess what's left is Best Buy. They try to get the foot traffic in, run the website, have to discount to match everyone else, and result they're off about 40%. But you also look at it in terms of, well, how many widescreen TVs can you sell in any given market? Well, it's not a finite situation. It is commoditized, highly commoditized. So thus you need to sell larger and larger screens. And I was out and about this weekend looking at some retailers, and I noticed what they call SKUs. In other words, the products that they offer, where at one time the average, we'll say, price was $25 to perhaps the higher end at many of these places, the Targets, the Best Buys, etc. The Sears were around $50. But now they have moved up. The earphones for the Xbox and just your personal quote-unquote listening device, smartphone, whoever you got going there, are moving up above the $120 mark to about $220. But those are highly commoditized too. You can go to Amazon and find a number of people there, save $5 or $10 or what if the special is not on. So this is one of the things we have to look more and more to our models. But back to the consumer sentiment here from Christopher Lowe. He's the chief economist at FTN Financial in New York. People have been shocked by how much mortgage rates have risen in the past couple of months. Of course, as housing rises, and it has, mortgage rates will rise also. I think we see an increasingly cautious consumer in the second half. Well, the thing with consumers, they have their mortgages, but if the rate has risen, for many, their wages have stagnated. Some have received, we'll say, 1, 2, at the most 3% increases, but as these things rise, interest rates, I should say mortgage rates, and for people that rent, the rental market is very hot in many areas, very tight also in terms of vacancies. The housing starts rose 5.9% to a seasonally adjusted annual rate of, we'll call it 900,000 units. That's from the Department of Commerce in a separate report. While that was a recovery from June's decline, it's below expectations of economists. Again, this is back to the models. They were roughly at 900,000 units there. Well, we call it 900,000. The actual number, let's see, was 896. That's for short of that. That's petty dickering, basically speaking there. It does make a difference in terms of units or dollars brought about, but again, when we look at this, we have to consider also housing as many separate units across many regional sectors, example Northeast, Southwest, etc., and many states where the situations are a little different. What we looked at a few weeks back was the housing situation in Phoenix, Arizona, very interesting, bright spot, but in many other localities, new houses are moving, but is somewhat hampered based upon the number of lots that can be bought, and secondly, the number of contractors, subcontractors, and the cost of so-called raw materials there, and of the number of workers to do this, because housing has been cool basically for a number of years now, so they're doing some new houses. They primarily were pushing foreclosed housing units, and a lot of those foreclosed housing units are coming back on the market. And this is where we get to the rental piece, that a lot of those have been turned into rental properties because people that had mortgages that were foreclosed upon are out of the homeowner sector, and other people have not went in it, and as long as interest rates are up for homeowners, for mortgages, they will not go into it. I think we are looking at a situation where some air is coming out of the housing recovery, given the high mortgage rates. That's from Michael Hansen. He's a senior economist at Bank of America Merrill Lynch in New York, that has a lot of mortgage products, and at the same time they have a lot of foreclosed properties. Long-term interest rates have risen by more than a full percentage point over the past 3 months, on the view that the Fed will soon taper the quantitative easing. That in turn has prompted a rise in mortgage rates, which threatened to snap some of the strength from the housing recovery that has been pushing prices higher for more than a year. This is one of the problems you have when you have an economy that is basically not controlled. People tend to take advantage of certain things, and now they are to raise their rates, but at the same time they will stifle the rest of the industry. So in other words, they will get that extra point on the people that have the mortgages now, but at the same time it could end up being a 2-for-1 deal. New houses that would take up mortgages will not materialize, and at the same time it affects the economy, which ultimately affects consumer spending. You can see where we're going with this little roadmap. Economists expect the U.S. Central Bank to make the announcement. Well, that'll be in September. Government bond yields pushed to a 2-year high, anticipation of Fed's action. Everybody is sitting on the fence waiting. Permits for future house construction jumped to 2.7 in July. That is a 943,000 unit pace. The increase was anyway, we're talking about a little bit below the expectations, which were too high at 945,000. Dan Silver, he's an economist at J.P. Morgan, another financial institution that is heavily invested in quote-unquote Housing Products said the July start data makes it less likely residential investment will reach the 17% annual rate that the investment bank expected for the third quarter, Q3. Well, 17% itself was a bit high. There, I would look, at least to us, more like about 12 to 15% at best. Hitting the target is one of the assumptions underpinning of the GP's 2.5% GMP growth estimated for Q3. Well, Q3 has always been problematic and will continue to be problematic, at least from the days we've been around looking at this, which is, I should say, years, a lot of years. The July data on industrial production, residential construction, employment, missed market forecast. The economy grew at a 1.7% pace in the second quarter. Well, the second quarter itself, coming off of the first quarter, was very problematic by what they would call climatic conditions. Residential construction figures last month could also be a reflection of supply restraints. We talked about that, so we'll skip that. And we'll look at single-family builders, an 8-year high in August, with builders upbeat. Well, they have reason to be. Anecdotal information, look at a little bit of that. Builders may be holding back on new construction in part to reap the benefits of higher prices. Well, a little opportunism going there. That's from Gary Brugger. He's an economist at RBS in Stamford, Connecticut. Groundbreakings for single family houses. The largest sector of the market fell 2.2% to the lowest level since November last year. Starts for multifamily housing, that's apartments, etc., jumped 26%, reversing prior month's decline. Permits for multifamily homes rose 12.6%. But approvals for single-family homes, again, a tightness of credit here. We're having problems with freeing that up at 1.9%. So that is from the Reuters. We'll look at Bloomberg here. We don't want to jump too far, but we did talk a little bit about Dell. Dell has a shareholders meeting coming up, and let me just make sure my information is okay. It says on the 16th. We don't want to be too dated here. Rose less than 1% there at basically 1382 is where old Dell is there. Silver Lake is offering, that's one of the suitors, at $13.75 a share. Revenues ended August 1, changed a little, for $14.5 billion compared with $14.2 billion was the analyst projection, a little bit better there. The dividend is one of the more important things. Increased special dividend. This was Michael Dell there. They had several meetings here. Let's see, special dividend of 8 cents a share. The committee promptly rejected an increase of 13 cents a share. So dividends is very important sometimes these low performance stocks here. Carl Icahn, of course, is in the mix here, putting his share of the company at 8.9%, almost 9%. Dell has 15.6%. Southeastern Asset Manages, that's his partner. They're in the mix there. So in other words, let's see, Dell, Icahn, and Southwest, let's see, to like 12 directors. They've canceled this a number of times. Second quarter PC sales dropped 10.9% to 77 million. That baffles me a little bit. That's according to Gartner, in the business of analyzing things. Dell gets more than half of its sales from desktops, laptops, and related products. You can see what's going on here. They've got some problems, which are being replaced by many consumers, business users, by tablet computers. So again, Dell is really not in sync there as far as that is concerned. Dell's end-user computer revenue, which includes PCs and thin client computers of a back office, declined 5%, and it will no doubt decline more than that, because the tablets can be used as thin clients, etc. So that is the pain that Dell is suffering here, and you can expect them to perhaps suffer more pain as it goes along there, and IBM and others have had to make some much needed adjustments, and adjustments of course will continue to be made. Let's look at while we're here, we'll look at China with Bloomberg. Housing in China, we just jump around here a little bit, but anyway, July house prices rise in the big cities. This is in China now. In July, led by gains in the biggest metropolitan centers, prices climbed in 69 of 70 cities. That's the National Statistical Bureau. The Southern Business Center of Shanghai posted the biggest gain of 17% from a year ago. Prices in Beijing, Shanghai increased 14%. So that's up. We don't have that type of market here. New relationships seem to have a different mentality on profit policy. Let me go back here to Jack Gong. It's unlikely the government will release a new round of property curbs, even if housing prices continue to rise. And this is one of the big problems here. The new leadership seems to have a different mentality on property prices, no doubt about that. This is from Jack Gong. He's in Hong Kong. The new government may be less interested in tightening measures, but allowing the market to play a bigger role. That is very problematic in from our standpoint. And we move, let's see, China seeks stability and healthy developments in the property market, the government says on its website. The government may release long-term mechanisms for stability and healthy development in about 3 months. And that was citing Mr. Shai Zhangti. He's the deputy head of the Chinese Real Estate Association. China in March stepped up a 3-year campaign to cool housing prices, with only the capital city Beijing issuing the toughest measures among 35 provinces. So you see some controls there. Private data shows rising house prices. Home prices jumped 7.9% from a year ago. The value of sales fell 17% in July. Well, that was reported on the 9th there. Smaller cities have already begun easing some of the policies designed to restrain price gains. I won't go much into that, but the only city with decline among the 70, Washan, saw new housing prices fall 2.4%. 2.4% is not bad at all. Yang, at the Shanghai-based research property Santel Line Property Agency, that's the biggest real estate broker in China. Before today's release, Lu expected housing prices in cities to rise about 10% this year from 2012. Housing prices will stabilize in the second half of the year. The government forecast on long-term development of the market rather than track down it. That's from Yi Lang. He's president of a company there. China Vesky, this is the company's biggest developer on mainland exchanges, etc. So this is sort of for the Chinese market. People will look there, and I suppose while we're there, we'll look at gold. We don't usually do much on gold. I ran into a fellow the other day that was into gold. Gold seems climbing from a 2-month high on the Asia fiscal demand. Asia may extend a rally for 2-month high as increases in demand from jewelry buyers in China and of course India there. Prices may rise as much as $15.50 an ounce by the end of the year. That's from Jeffrey Rose. He's managing director of Financial Institution Division of Kaluti Jewelry Group. That's Dubai based. We usually will give that Dubai gold here. There's no sign of demand abating from India gold convention. Well, it may get any trim gold's first loss in 13 years after some investors lost faith in the metal as a stored value and expectation the U.S. economy was recovering. The metal has rebounded 17% since reaching a 4-month low of $1,850 an ounce. That was in June. We saw that in demand for bars. Corn soared from India to China to Turkey. The surge in demand may help counter a sell-off in bullion-backed exchange trade funds by billionaire John Paulson. Underlying the strength in physical demand will underpin gold prices, and there has been sign of Western investors coming back to gold. That's from Mr. Rhodes again. The economies are doing much better, but we are still in a world of negative interest rates, so tilt to gold. Well, interest rates are rising in the U.S., and be leery. Consumer demand in India, the biggest buyer, jumped to 71% in the second quarter, and in China, the second one, it gained 87%, helping to push global bar and corn purchases. That's what this fellow was talking about. It's so interesting to get anecdotal information and backed up by statistical information. A record jewelry usage since 2008, the beginning of the Depression in the U.S. Producer Fund Gold Council said, that was on the 15th of August. The metal rallied to $13.76 an ounce in London. That was on the 16th, just a few days ago. The highest price at closing since the 17th June, paring losses to 18% this year. Prices will rally to about $14.30 by year end because of fiscal demand from China, India, and the Mideast. So that's according to Cameron Alexander, an analyst at Thomson Reuters. In the interview, bullion may climb to its highest at 1,775 in Q1 of 2014, before declining because of improving economies. Well, if the economies do improve, yes, gold prices go down. You can look at that. Holdings in gold exchange products were down 26% this year, swiping 55.5 billion value from the assets. Paulson, the biggest investor, and he's in SPDR Gold Trust, the largest gold trust, cut his stake by a little over half, 53% in the second quarter. And that showed that silver, the rally also to $30 an ounce by the end of the year. That's from Mr. Rhodes. The metal, rallied 13% last week. It's at $23. Basically, 0.2575, the most since, again, the beginning of the Depression here, 2008. Gold imports by India may tumble to about 150 tons in the 6 months through December from 778 tons a year ago because of increase in tax and central bank curbs. That's from the Bombay Bullion Association. A surge in shipments in the second quarter prompted the government to increase a tax on imports for a third time this year to 10% to contain the record currency account deficit that has weakened the rupee. The rupee, incidentally, has went down, and we'll move to the rupee now. Looking at our time, well, we better get to the rupee. And that'll be from the BBC. We're at Bloomberg, but quickly we'll get to the rupee. In India, on our international trade, rupee hits new record low against the dollar. On Wednesday, the central bank in India put further, we already talked about that. That had little impact. The rupee fell to 62.0 to a dollar, below the previous 61. That was on the 6th of August. Overseas investors have been pulling money out of Indian shares and concern over their economy. According to official data. International investors have withdrew 11.58 billion shares in debt from the Indian market since the beginning of June. Inflation fears. The economy has been growing at a fast clip, reaching an annual growth rate of 9%. Only dream of it in the West. There's a complete lack of faith in the markets. There are fears that the Reserve Bank of India may not have helped improve the rupee measurements. There. That's from Para Sharma, chief executive at NSP. Indian authorities were concerned that the weak rupee is stoking inflation. The company relies on imports of crude oil. We'll look at that in just a minute here. Chemicals and some foodstuff, which are priced in dollars. So in other words, things are more expensive in India. Indian goods are less expensive here. It'd be interesting to look at some of these IT contracts and see they're usually in dollars, not rupees. But if they were in rupees, it'd be interesting. The rupee, weak rupee makes them expensive, a cost that is handed on to consumers. Watch out, in July, the main gauge of inflation, that's in India, wholesale price index was up 5.79 over the last year, up from 8.86. We'll move now to do the numbers because we probably, I guess you'd say, done as much damage here as we can do. But there's some very interesting data. I'm very impressed on the precious metals and where they're coming from. And this fellow that I thought was sort of out to lunch wasn't too much, at least on gold coinage. Nonetheless, this is Friday, unless otherwise noted. The FTSE was up 16.65. The DAC in Frankfurt was up 15.65. In Paris, they were up 30.69. In Brussels, 12.85. In Madrid, 83.76. Zurich, they were down 21.12. In Bombay, they were also down 769.41. Karachi, 956 in the negative. Lahore also in the negative, 17.30. Colombo was actually in positive on Friday at 13.11. They were in the negative in Tehran on Wednesday, 144.60. In Sydney, they were down 36.60. The Nikkei was also down 105.83 on Friday. The Hang Seng was down 21.44. In Shanghai, they were down 13.43. In New York, they were down 30.72. The Nasdaq, the tech-laden one, was down 3.34 or 0.09 tenths of a percent. The Merc out in Chicago was also up. That's the commodities market in the U.S. at 5.79. In São Paulo, on Friday, they were in the positive, 630.44. Mexico was also down 105.64 on Friday. And finally, we'll look at these commodity prices, which are in the mix, causing inflation in India and elsewhere. And we'll get to Brent crude, very important. It was up $1.06. That's the futures on a barrel. The spot was down 75 cents at 110.06. Same thing. The future was at 110.66. Anyway, West Texas Intermediate was up 54 cents. T-Boone Picking is jumping for joy there at 107.76. In other words, $107.76. He remembers when it was $15 a bale. Coffee futures were down $1.35. Cotton was up $1.76. These are on Friday. Sugar was down 25 cents. World sugar futures. And, anyway, Dubai Gold was up $29.30. That is a 2.2% rise there at at 1,000 $364. So it has been up. The Forex Gold Index was up $21.26. So we usually go by to buy gold, more effect on India and the rest of that market out there. Corn futures were down $7.75. That won't help India as much. They don't import as much corn. Oats were also down $5.25. Soybeans were down $5. Soybean oil was down 31 cents. Wheat futures, which does affect them, was down $6.50. That'll take a little bit of pressure off of India. Cocoa was also down $2 there. Corn futures, this is on the Eurodex, was let's see, let me get that down 50 cents. So we'll sort of end it at that. We won't mess around with that very much. Nonetheless, this will end our production here. This is Numbers Man wishing everyone a good weekend and a productive next week for those in business, and for the consumers, keep your eye on the ball. The sales will be out there for back to school operation. As summer holidays wind down for many people, we'll be looking at leisure and see has it increased. Gas prices, incidentally, at least within the U.S., petrol prices, have been moderated. Normally in the summer driving season they go up. And this is a good indication that there's just not a lot of loose liquidity out in the economy. In other words, consumers are stretched. They are doing minimal sorts of things, so cheaper gas prices does boat to cheaper travel. So we'll look at airline travel and some more things in future programs. Good day.